Moving averages are great indicators for identifying the trend of the market. By utilizing crossovers of multiple moving averages, you can even make a strategy based on them. However, if you have been using moving averages long enough, you will probably have noticed that the signals are usually right, but that the signals are provided after the opportunity to enter into the position has already passed. In the following strategy, we will be considering the green moving average crossing above the red moving average to be a bullish signal, and the green moving average crossing below the red moving average to be a bearish signal. As you can see, by using this simple strategy, profitable signals will be given. Here we see that a bullish signal was given due to the green moving average crossing above the red moving average. We see that after this signal was given, the price indeed moved in the upward direction. However, if we look at the exact point at which we would have entered, you will notice that the signal was delayed and given after the big move had already happened. Here we see that the opposite has happened with a sell position. The moving averages made a bearish crossover. We also see that the price made a bearish move. But after taking a closer look, we see that the move had already occurred, meaning that we would have already missed the largest part of the move if we had entered into the position. The solution to this are the zero lag moving average indicators. A zero lag moving average is a technical analysis tool that eliminates lag by using a combination of exponential and linear regression calculations to provide real-time non-delayed insights. The indicator is similar to the moving average, but works a bit differently, so it's important to first understand how the indicator works. Let's add these indicators to the chart. To do this, head over to the Indicator Search tab and search for the double exponential moving average indicator. Select the indicator made by TradingView and add it to the chart. The second indicator we will be adding is the triple exponential moving average. Search for the triple exponential moving average indicator and select the indicator made by TradingView. The first indicator that we added is also known as the Dima. This indicator is a 2-period exponential moving average that aims to eliminate lag by placing more weight on recent prices. The second indicator we added to the chart is the triple exponential moving average, also known as the Dima. This indicator is a 3-period exponential moving average that takes the Dima a step further by applying a second smoothing to the Dima line. The Dima provides even smoother and even more responsive signals, but can also be more susceptible to noise. This is why we have also added the double exponential moving average. Now that you know exactly how the indicators work, let's take a look at how we can use these indicators. The first method for using these indicators is by using trend analysis. The direction of the Dima and Dima show the overall market trend. As you can see here, both lines are moving in the downward direction, which means that the price is likely to fall even further. The opposite is true when the lines are moving in an upwards direction. As you can see, this is the case here, making it more likely for the price to continue in the upwards direction. You could also use a similar method by only using one of the zero lag moving averages. In this case, we will choose to use the Dima indicator. As you can see, whenever the price crosses above the Dima, the trend switches to a bullish trend, and whenever the price crossed below the Dima, the price switches to a bearish trend. Even so, you will quickly notice that many false signals occur usually while the price is ranging. That's why we also need for the Dima line to be moving in the upwards direction. As you can see in these cases, when the price crosses above the Dima and is moving in the upwards direction, there is a high probability of an uptrend following. We can also see that the opposite is true for bearish crossovers and downtrends. If the Dima is pointing in the downward direction, the signal will usually result in the start of a new bearish trend. The second approach for interpreting zero lag moving averages involves utilizing them as fluctuating support and resistance levels. If we take a look at the price action, we can see that the price frequently bounces off the zero lag moving averages. This is because when the price pulls back to the zero lag moving averages, it can be seen as a dynamic support point, allowing for the price to continue in the upwards direction. On the other hand, if the price is in a downtrend and pulls into the zero lag moving averages, they can act as dynamic resistance points, causing for the price to continue in its bearish trend. Not every pullback will cause the price to reverse back to its original course. To be able to find these support and resistance points, we will need to look for points in the market where the price action had already bounced off the Dima. As you can see, this is the case here. This means that there is a high likelihood that the next time the price reaches the Dima, the price will bounce back off it. Let's take a look and see if that will be the case. Now that we know exactly how to use the zero lag moving averages, let's take a look at how we will use them to enter into a position. But before that, if you are looking for a broker that has extremely low commissions and spreads, then check out Henko Trade. The best broker to trade Forex, indices, commodities, or crypto. They have live chat support so that any questions you may have can be quickly and easily answered. One of Henko Trade's most prominent promotional offers is the matching deposit bonus that can be claimed when you open an account with Henko Trade. Sign up via the link in the description to register with Henko Trade and get access to all of these perks. For the first strategy, we will be using both the 50-period Dima along with the 50-period Dima. To enter into a buy position, we will first need for a crossover to occur where the Dima crosses above the Dima. After the crossover, we will need for the price to start moving in the upwards direction, showing us that an uptrend has begun. Once this has occurred, we will be looking for the price to pull back into the Dima. We can see that this happened here. It's also important that the price does not break below the most recent support zone. If the price does make a lower low, then we will ignore the signal. In this case, the price didn't cross below any support zones, so we will now enter into the position once the price closes above the Dima again. The price has closed above the Dima, so let's enter into the buy position. We will be placing the stop loss at the recent swing low. For the take profit, we will be targeting a 1.5 times risk to reward ratio. Now let's see how the trade plays out. To enter into a short position with the strategy, we will first be looking for the Dima to cross below the Dima. After the crossover, we will need for the price to start moving in the downwards direction, showing us that a downtrend has begun. Once this has happened, we will want for the price to pull back into the Dima without breaking through any resistance points. We can see this happening here. Finally, once the price closes back below the Dima, we will enter into the position. We will be placing the stop loss at the recent swing high. For the take profit, we will target a 1.5 times risk to reward ratio. Now let's see how the trade plays out. A different strategy to use with the zero lag moving averages involves adding 3 double exponential moving averages or triple exponential moving averages, all with different lengths to the chart. In this particular strategy, we are using 3 different periods of Dima, the 10, 50, and 200 period Dima. The 200 period Dima is being used as the long-term trend filter indicator. This means that it will give us a clear indication of the market trend, and we will only take long positions when the price is trading above the 200 period Dima. Conversely, we will only take short positions when the price is trading below the 200 period Dima. The 10 and 50 period Dimas are being used to identify potential buy and sell signals. When the 10 period Dima crosses above the 50 period Dima, it signals a potential bullish trend, and we will enter into a buy position. However, this must happen while the price is trading above the 200 period Dima. As you can see, this is the case here, so let's enter into the position. If we take a look at the rest of the price action, we can see that other positions we could have entered in would have also been profitable. If the 10 period Dima crosses below the 50 period Dima while the price is also trading below the 200 period Dima, this will signal that this could be a good time to enter into a sell position. So let's enter into a sell position where this occurs. Please keep in mind that this strategy is meant to showcase the different ways the zero lag moving averages can be utilized when trading. I hope this video could showcase how powerful these zero lag moving averages are and the potential ways they can be utilized and integrated into different strategies. If you enjoyed the video, please leave a like and subscribe to the channel. If you have any questions, feel free to leave a comment.